Hello, ladies and gentlemen. Greg Mikulowski from ForexLive.com. This is a weekend Forex technical report where I take a look at some of the technicals that could be driving our markets in the new trading week and tell you why, most importantly. Hopefully you learn from these videos so that you can do it yourself. And that's the name of the game in trading, is to be self-motivated, to find the levels that are most beneficial to you. And I hope I lead you toward those levels from my analysis. Before we get started, let me talk about some of the major economic events that will be taking place this week that will shape our trading, shape the movements in some of our currency pairs. Start off with on Monday, we have Swiss CPI, expectation 0.5% for that. On Tuesday, we have the US CPI data, which is expected to be 0.5%. That's up from 0.1% last month. If you missed it, on Friday, they revised the CPI from last month to minus 0.1% to plus 0.1%. So a big difference there. We'll see what happens with the 0.5 if it comes out at that level. If it comes out worse, that's going to be a problem. If it comes out better, well, we're still in the game for lower inflation going forward. We also have the UK employment statistics coming out on Tuesday as well. On Wednesday, we have UK CPI coming out. And then later on, we would have the US retail sales and Empire manufacturing indices coming out. That's the first regional manufacturing indice for the month traditionally, followed by Philly Fed, Richmond Fed, things like that that give an overall view of the manufacturing indices in different parts of the country. So that will be released on Wednesday, and then on Thursday we have Australian employment change. Expected 20,000 versus minus 14.6 last month. The unemployment rate expected at 3.5%. That's unchanged from the prior month. And also on Thursday, we have our PPI data coming out of the U.S., where the expectations are 0.4% for the headline number, 0.3% for the core. So that's a look at the fundamentals. Let's take a look at the technicals. We'll start off like we usually do, taking a look at the euro versus US dollar. I'm going to take a look at the daily chart here and give you an idea of what is in play off of that chart, and then we'll dig down maybe into the hourly chart. So first off, this yellow area right through here, this yellow area was defined by different swing lows through here, and then we reversed to the downside and started to use this level as resistance before moving to the downside. We climbed our way back from the low price in September, and moved our way higher, higher, higher. Finally, in the month of January, the market moved above this yellow area and tried to stay above it through here, as you can see. And then in February, we moved back below the level. And in trading this week, what do we see? We saw the price action stay within this yellow area, below the top side of the yellow area, which comes in at 1.0805. Remember that level. Also remember the 107.509 level. That's the low end of this swing area through here. And on Friday, we stayed pretty much below that level. In fact, all the closes, I think, for the week were below the 1.07509 level. So that is a more bearish bias here. Just in the short term here, off the daily chart, which doesn't sound right, but in the short term, as long as the price remains below the 107.509, 108.08, this trend move to the upside has tinge of more negative here, at least on the daily chart. But we'll clarify that off the hourly chart as well. And on the downside, what do we have as targets in the new trading week? I'm outlining these different swing area levels through here where the market found either resistance or support. And then we traded above and below the level in early January, only to move back to the upside. So we're returning back to this 105.73 to 106.15 level. Keep that area in mind going into the new trading week. Mark that down on your daily chart, and we'll see. We should see some support in that area. Now let's take a look at the hourly chart. See about what the daily chart move of late looks like on the hourly chart. And if we take a look at this chart, this is the trading week this is a trading range for the week. This is Monday, Tuesday, Wednesday, Thursday, Friday. So we had this high through up here, which came in against prior highs through, or prior lows through here, I should say, and highs through here. Then we started to use this level as resistance. the market moved down. We returned back toward it here, but found early sellers. Now the return back toward it did take the price back above the 100-hour moving average, and also this swing area through here, where there are a number of different levels. And if I went back in time, it would increase that number of levels through here. So we did move above that level, but fell short of this area right through here, and also fell short of the 38.2% retracement of the move down from here to here. So that kept the sellers more in control, and we moved back below the 100-hour moving average. You can see we started to use sellers through here. And we had another break to the upside here. What did it do? It failed, and the market closed weak on Friday, actually taking out the low price from earlier in the week just by a few pips and rotated back to the upside. So what does all this say going forward? Well, taking a look at the daily chart again, we're below this yellow area right here through at 107.509. On the hourly chart, we are below the 100-hour moving average, and that level is going to be our resistance level on the top side. And you might also use this swing area through here, which comes in between 107.11 and 107.24, and that's ahead of the 107.50 level that we saw, 50 level that we saw on the daily chart. So this is close resistance here for the euro versus US dollar. As long as the price remains below that level, the bias remains to the downside, and it helps to support the daily shorter term bias to the downside below the 107.50 level. So does that make sense? I hope it does. Let's take a look at the dollar versus yen next. And again, we'll start off by taking a look at the daily chart. And when we look at the daily chart, one of the things I'm going to want to point out is if we go all the way back to this low right here, this is a swing low going all the way back to 2020. And we rallied all the way to the upside. And what do we do in the month of January? We came down toward the 50%, I should say, of that move to the upside. And we found support buyers against that area, and started to rotate back to the upside, correct back to the upside in trading. And off of the daily chart, I'm going to zoom in a little bit here, get a little closer view here off the daily chart. That we have a swing area right through here where we had a number of different swing highs through there, and then we rotated to the upside and started to use it as support. We've talked about this a lot because remember we came down, broke through this swing area, came down, tested the 100-day moving average, and bounced off of that, moving all the way to the upside, reestablishing support within that swing area. Now, in the month of December, we failed below that level, reestablished support, and then in January, did trade above and below it. But we also used the level as support right through here, moved down, and then used it as resistance through here. And the trading last week, the market moved above that area on Monday's trade, and it looked like we were going to break or correct more to the upside here. But we couldn't do that, and the price started to rotate back to the downside, back within this swing area through here on Thursday, Friday, actually Wednesday as well, and use that area as resistance. So the 131.24, 132.02 level is going to be a level of where we will see if there's going to be resistance on the top side and rotate back to the downside, or are we going to break through it on the top side and see the price move up toward these areas through here, maybe even all the way up to the 200-day moving average over time? We will see for the dollar versus yen, but right now the bias is somewhat neutral off the daily chart in between these swing areas at 131.24, 132.02. Now let's take a look at the hourly chart and see what the price action this week did on that chart. And looking at it, I'm not all that impressed, actually. There's lots of ups and downs, especially over the last 3 or so trading days where the market just couldn't figure out which way it wanted to go. We do have lower lows here, and we have a hodgepodge of highs through here over that period, which is somewhat, it ain't the best for us technical analysis or traders looking at what happened. I'm sure people got whipped around a bit, especially when it broke below the 200-hour moving average here, and then couldn't sustain that momentum and started to move back to the upside. We'll say that this level right through here, I'm going to draw a line through here, was somewhat significant as well, in addition to the 200-hour moving average. So the failure below things like the 200-hour moving average and then move back above that level, at least you had an idea of where your risk was, right? So if you sold below the 200-hour moving average, it's just a lesson, folks. If you sold below the 200-hour moving average right through here, what did you do? You bought when the market moved back above this level because of all these levels, all these swing levels through here. that help define this area. If I can click on the arrow instead, there we go. It makes it easier. That define these levels through here. So it would be a low risk trade, but it didn't work out. In this move to the downside, we saw further momentum to the downside, taking the price below the 50% of this move, and it looked like we were on our way to further lower levels. But as you can see, it snapped back higher and then reestablished support against this old red line right through here. So this level is going to be key, as is the 200-hour moving average, which is at the same level as well. So be aware of that. We're up here near the 100-hour moving average, however, and the 100-hour moving average is going to be our short-term barometer for the start of the week. Either trade above it and start to take out our highs through here, or trade below and start to work back toward the 200-hour moving average, toward this red line. So that's how I see the dollar versus yen shaping up. Let's take a look at the sterling versus US dollar. Again, we'll start off by the daily chart. And what we see here is that the low price that we saw in trading last week came really close to the 200-day moving average. That level comes in at 119.45. And we'll see on the hourly chart how the price just fell just short of that level and saw a bounce to the upside. So that's good news for the short-term buyers who leaned against that 200-day moving average, as you do, with risk below. And you had a nice little trade to the upside there. Made a few pips off of that. On the top side here off the daily chart, what has been important going and will be important going forward is this level through here, where we have a number of different swing highs. So we have a nice little ceiling in place off the daily chart. Now, admittedly, we are a number of big figures away from those levels up there at the highs, and in between we have this swing area as well, on the 50% retracement of this move to the downside. All these levels come in play on further momentum to the upside, but just be aware of it and get a view, get an understand your levels. And when they come into play, when we get closer to the 50%, when we get closer to the swing area, when we get closer to these highs, we are aware and prepared. So 200-day moving average, 50% swing highs right through here, all important from the daily chart. Now let's drill down to the hourly chart and see what that is telling us. And remember, I mentioned the 200-day moving average on the daily chart. Well, this is how close we got to that moving average. The market came down to 119.60. The moving average was somewhere around the 119.54 or 3 level. So we got within around 6-7 pips of that moving average, and the market started to rotate back to the upside. We tried to stay below the 100-hour moving average through here, but couldn't do it and started to move back above that level. Found buyers on the momentum above the 100-hour moving average. And where do we stop? The 200-hour moving average. So if I were to characterize the trading week last week, it was support at the 200-day moving average, resistance at the 200-hour moving average, and the market rotated back down. And we were closing the week below the 100-hour moving average. Comes in 120.73.9. As long as the price can remain below that level, that's our short-term barometer. Remember, we held it through here and then broke above it here. So trading back below that moving average gives the sellers the advantage in the short term. And we'll see if the momentum to the downside can continue for that pair toward this swing area, and then back toward our lows and back toward our 200-day moving average. That's the goal for the sellers in trading this week. If that price can stay below the 100-hour moving average, if it moves back above the 100-hour moving average, all bets are off. We look toward the highs through here, and then look toward the 200-hour moving average and 38.2% retracement of the move down from our high that we saw here in the end of January to the low that we saw here at the beginning of February. So that would be our target right here, along with the 200-hour moving average, not far away from it and moving down toward it. So that is the sterling versus U.S. dollar technical look. Let's take a look at the dollar versus Swiss franc. And the best part of this chart on the daily chart, one of the most strongest parts, I guess, is the failure on the break below this swing area. The swing area had a number of different lows, making a nice little floor there before the market moved into the basement right through here, but it could not just stay below the basement, and the floor became a ceiling, and the market broke back through the ceiling and started to move back to the high price, move higher. Now, we did enter into this consolidation quagmire through here in the month of February, and then rotated back to the downside in this trading this week. We fell below this swing area, if you can call it such. It's Wouldn't necessarily call it the best of swing areas. We did have a failed break here. We traded above it, below it all through here a number of different days. So I'm not necessarily in love with it, but I'll live with it, I guess. And this level down here at the 0.91465 is a level of somewhat significance. Again, wouldn't necessarily call it another one of those things that I love, but I'll live with it as well. So 91.465, if we move below that level, I think the daily chart turns a little bit more to the downside from that perspective. Let's take a look at the hourly chart and see if we get any better clues from it. And if we take a look at what I like about this a little bit, which is a little bit cleaner and a little easier to see, is this swing area through here, where we have a number of different swing highs coming to play. So a nice little ceiling there, and we utilize that ceiling as resistance in trading parts of the trading this week and last week. So that this area between the 0.9278 and 0.9290 is going to be somewhat key on the top side. On the downside, or below on the downside, we did find support on Friday against the 200-hour moving average. Admittedly, it got messy through here. It didn't necessarily follow along like we hope, but on the dip down on Friday, we bounced off of that level. That increases the level's importance going forward, and we did try to hold on 100-hour moving average through here. So as long as the price remains above the 100-hour moving average, the bias remains to the upside toward this area up through here. If the price moves below the 100-hour moving average, we're going to be looking down toward the 200-hour moving average and see what happens next at that level on a dip down toward it. So that's our dollar versus Swiss look. Let's take a look at the dollar versus Canada next. On the daily chart, lots of ups and downs that we've seen in this currency pair of late. If we put a box around this price action, there's lots of red and green bars through there with moves to the downside, move to the upside, move to the downside, moves to the downside and upside in days. And in trading this week, we are closing lower. Why? Because we saw a very strong jobs report coming out of Canada on the equivalent of the 517,000, if not stronger, with about 150,000 gain in jobs on Friday. That's the second month in a row where we had over the expectation, 69,000 the prior month. So the job situation, both Canada and the U.S., are very strong and very similar, and makes central bank policy somewhat difficult. Remember, the Bank of Canada did enter into a conditional pause in their rates, which I guess we have to take for their word, but it's going to be hard to imagine that inflation might stay subdued with employment so high, but the dynamics in Canada are different with their mortgage rates and so on and so forth. The variable rate mortgages raise the cost of home ownership, which should slow growth faster in that country than potentially in the U.S. So keep that in mind, and perhaps that is why the move to the downside on Friday was to the downside, but we didn't go and take out lows, for instance, for the month or into this, even get into the swing area between 132.96 and 133.20. We'll be watching that level on the downside on the daily chart. If the price can get below that level, then we're going to look toward our low price that we saw in the beginning of February, and then look toward this swing area down through here, where we had a number of different swing highs forming a ceiling. Then we found some lows here forming a floor. And we haven't been back to it, so we'll be watching that along with the 200-day moving average. That would be the bias direction. That would be the targets on the downside for the dollar versus Canada if we continue this trend in that direction. Let's take a look at the hourly chart. And on the hourly chart, we see all the gobbledygook and ups and downs and so on and so forth. We are near a swing area here between the 133.39 and 133.58. I don't have to outline all the levels. You can see it yourself. Admittedly, we move below it through here, move below it through here, and here, and here, and here. So it's just an interim level that if we break below it, it would be more bearish. Also, we are below the 200-hour moving average. And what is important on this is that when we had the employment report move sharply to the downside, we corrected up toward that 200-hour moving average, found sellers against it, and pushed the price to the downside. So the sellers remained in control. So that 200-hour moving average is going to be our key barometer in the new trading week. As long as the price can remain below that level, the bias remains to the downside for the dollar versus Canada. All right, let's take a look at the Aussie versus US dollar as our next currency pair. And if we take a look at this from the daily chart, what we see here is that the market tried to bottom near the 50% retracement on Wednesday, Thursday, and Friday. That level comes in at 0.6915. We also bottomed on Monday within this swing area with a number of different swing lows and highs going back in time. If we outline those levels, you can see the importance of that swing area as a risk bias defining level in the short term and or off the daily chart going back a long time ago. So pay attention to this swing area in the 200-day moving average on the downside. So watch the 50%, and if we move below the 50%, this wide batch swatch, I guess, and then the 200-day moving average on the downside is going to be our levels to watch. If we hold the 50%, we're going to look toward the high prices that we saw last week near the 70 level. So pay attention to that. Let's take a look at the hourly chart in the Aussie versus US dollar. And what I like about this is we had a nice little trend line here where it started here. Started there, and then we held support through here. I get along that trend line, tried to hold support through here, and fell below that level, and then used the underside of the trend line as resistance. So although we had higher prices through here and traded above the 100-hour moving average here in up and down fashion, we did use this whole trend line as resistance, keeping the sellers probably more in control here, even though we traded above the 100-hour moving average. Now we are closing below the 100-hour moving average at 0.69391, and that's going to be our close resistance in the new trading week. As long as the price can remain below the 100-hour moving average, bias remains to the downside, and we'll look toward our low prices for the week. If we move back above that level, we'll look toward the 38.2% retracement, and then 200-hour moving average, and then this swing area through here, defined by these swing levels, which were broken, but we found the 200-hour moving average, and that turned the price back to the downside. Finally, let's take a look at the New Zealand versus US dollar. And this is a daily chart. And in trading this week, what do? We found support buyers against the 50% midpoint of the move down from the 2022 high to the 2022 low. 50% retracement comes near the 0.6271. And as you can see, on Monday and Tuesday, the price did find support buyers against that level. On the top side, we had this swing area through here where the market highs found resistance. So we are trading between the swing area up here and the 50% retracement down here. Break below the 50, we're going to look toward the 200. If we break above the swing area, we look toward the 61.8% retracement of the move down from the 2022 high to the 2022 low. Now let's take a look at the hourly chart and see what that says and with the ups and downs that we saw. And on the move to the upside, we did find resistance ahead of the 200-hour moving average right through here, and the inability to move above that level was somewhat significant. Also stay below the 50% retracement of the most recent move down, so that was more bearish. On the downside, we traded like the Aussie versus US dollar. We traded back above and below the 100-bar moving average, so it was somewhat uncommitted on Friday, but we are closing below that 100-hour moving average, and that moving average will be our barometer in the new trading week as long as the price can remain below the 100-hour moving average at 0.6322. Bias remains more to the downside. Watch this swing area through here for clues. If we break below the 0.6295 to 0.6302 level, that should increase the bearish bias, looking toward our low price that we saw in the trading week. So there you have it. Look at all the major currencies. A little bit about what the key events are going to be next week. My name is Greg Michalowski. Have a great week and good fortune with your trading. Bye-bye now.